Picture this, it's Monday morning, you're half awake, craving that glorious caffeine hit, and your trusty coffee machine, your daily beacon of hope, decides to stage a dramatic exit. Smoke, sparks, the whole 9 yards. Now, you've been diligently saving for that dream vacation, eyeing tropical beaches and frosty beverages. But suddenly, your carefully curated vacation fund is staring down the barrel of an unexpected $300 coffee machine replacement. Suddenly, the tropical breezes feel a lot more like a brisk wind in your empty wallet. Sound familiar? We all face these curveballs, don't we? What does a defunct coffee maker have to do with the thrilling, sometimes terrifying, world of the stock market? More than you might think. Just like rushing into buying a fancy espresso maker without checking if it fits your counter, people often dive into investing without understanding the foundational, often overlooked, principles. And trust me, the financial equivalent of a coffee machine malfunction can be far more costly than just missing your morning latte. It can derail your financial future. We're talking real money, real dreams, real "I wish I'd known that" moments. Today, we're pulling back the curtain on 10 costly stock market basics mistakes that almost everyone makes, especially when they're just starting out. Consider this your friendly, slightly sarcastic, guide through the investment wilderness. We'll uncover how everyday habits and understandable human psychology can silently sabotage your financial goals, turning potential profits into phantom losses. Think of it as learning to defuse financial landmines, one chuckle-worthy anecdote at a time. Because let's be honest, nobody wants to step on a financial landmine, especially when it's disguised as a sure thing. Before we dive into the pitfalls, let's demystify the stock market itself. Imagine your favorite company, let's say, that tech giant with the shiny fruit logo. When you buy a stock, you're essentially buying a tiny, tiny slice of that company. You become a part owner, a miniature shareholder, with all the bragging rights that come with it. When the company does well, your little slice tends to grow in value. When it doesn't, well, your slice might shrink a bit. Simple, right? It's like owning a single crumb of a very large, potentially delicious, pie. Alright, mistake number 1, and it's a doozy: investing without an emergency fund. Remember our friend with the busted coffee machine? Imagine if that was your only spare cash. The stock market, bless its volatile heart, doesn't care about your unexpected car repairs or impromptu root canals. It's like building a skyscraper on quicksand. You need a solid foundation, a financial safety net, before you start climbing those investment ladders. Otherwise, any sudden gust of wind, or broken appliance, can send your investment portfolio crashing down, forcing you to sell at the worst possible time. Let's say you poured every spare penny into a promising stock. You're feeling good, maybe even a little smug. Then, bam, life happens. Your car decides it's time to visit the mechanic for a 5-star spa treatment, costing you $1,000. Without that emergency fund, you're forced to sell your investments, often at a loss, just to cover the immediate need. This isn't just inconvenient, it's a costly double whammy. You lose money on your investment and you miss out on its potential future growth. It's like selling your umbrella just as the storm clouds gather. The golden rule? Accumulate 3 to 6 months' worth of living expenses in an easily accessible, low-risk account before you even think about buying a single stock. This isn't fancy, it's fundamental. It's your financial airbag, your safety net, your superhero cape against life's unpredictable villains. Once that's locked down, then, and only then, can you venture into the stock market with confidence, knowing you won't be forced to liquidate your assets at the worst possible moment. Think of it as putting on your seatbelt before a thrilling roller coaster ride. Mistake number 2, investing without understanding what you're buying. This is affectionately known as the dartboard strategy, where you pick stocks based on a name you like, a logo you recognize, or perhaps the advice of that financial guru at the office water cooler. Imagine buying a car based solely on its color, without checking the engine, the mileage, or if it even has wheels. Sounds absurd for a car, but it happens daily in the stock market. You wouldn't buy a house blind, so why would you buy a piece of a company that way? Take Sarah, for instance. She loved a certain brand of super trendy sneakers, so she bought shares in the shoe company. Seemed logical, right? Except she didn't look at their financials, their competition, or their long-term strategy. Turns out, the company was struggling with supply chain issues, declining sales, and a management team that communicated primarily through interpretive dance. Sarah's investment? It stumbled, then tripped, and eventually face-planted. Her logical pick turned into a rather illogical loss, all because she skipped the fundamental research. Before you click buy, take a moment. Understand what the company does, how it makes money, who its competitors are, and what its future prospects look like. Are they innovating or stagnating? Are their balance sheets more organized than your sock drawer, or a chaotic mess? This doesn't require a finance degree, just a willingness to read and learn. Think of it as dating before proposing. You get to know the company, its quirks, its strengths, and its weaknesses. Don't rush into a financial marriage based on a first impression. Mistake number 3, chasing hot tips and succumbing to FOMO, the fear of missing out. Someone whispers about a guaranteed stock that's about to explode. Your friend's cousin's neighbor's dog walker made a fortune on it. Your brain, usually a bastion of logic, suddenly decides this is perfectly sound financial advice. You feel that primal urge to jump in, afraid you'll be left behind when everyone else gets rich. It's the investing equivalent of buying a lottery ticket because this time it's different, except with more sophisticated marketing. We've all seen the headlines about meme stocks, where companies with questionable fundamentals suddenly rocketed sky-high based on internet hype alone. People, often beginners, piled in, convinced they were getting in on the ground floor of a once-in-a-lifetime opportunity. What happened next? Gravity. Pure, unadulterated financial gravity. Many learned the hard way that when something sounds too good to be true, it almost certainly is. The only thing guaranteed in the stock market is that nothing is guaranteed. Instead of chasing rainbows and listening to anonymous internet gurus, focus on solid, fundamental research. Invest in companies you understand, with strong business models and growth potential. Remember, legitimate opportunities rarely shout from the rooftops, they often require quiet, diligent investigation. If everyone is talking about it, chances are, the smart money has already made its move. Be a tortoise, not a hare, in this race. Slow and steady wins the investment race, not a sprint fueled by breathless excitement. Mistake number 4, trying to time the market. This is the financial equivalent of trying to catch lightning in a bottle, blindfolded, during a hurricane. We all dream of buying at the absolute bottom and selling at the peak, perfectly predicting every market twist and turn. Unfortunately, even the most seasoned professionals with armies of analysts and supercomputers can't consistently do it. Yet, beginners, armed with a hunch and a YouTube video, often believe they can outsmart the collective wisdom of millions of investors. It's charming, if a little naive. History consistently shows that attempting to time the market is a losing game. You not only have to be right about when to get out, but also when to get back in. Miss just a few of the market's best days, and your returns can plummet. Imagine you're at a party, trying to guess the exact moment the DJ plays your favorite song. You might get lucky once, but you'll probably miss most of the good tunes standing by the door. Far better to just stay on the dance floor and enjoy the music, even if there are a few slow jams. Instead of guessing, embrace time in the market. This means investing regularly, consistently, and holding for the long term. This strategy, known as dollar cost averaging, smooths out the ups and downs. When prices are high, your fixed investment buys fewer shares. When prices are low, it buys more. Over time, you average out your purchase price. It's the slow and steady approach that boringly, yet consistently, wins the race. Your portfolio isn't a sprint, It's a marathon where consistency beats frantic bursts of energy. Mistake number 5, panicking and selling during market downturns. The market is like a moody teenager, it has its ups and its downs. When those downs hit, the news gets dramatic, headlines scream crash, and suddenly, your carefully nurtured portfolio looks like it's taking a nosedive off a cliff. Your primal fight or flight instinct kicks in, and for many, flight means hitting that sell button, locking in losses, and escaping the perceived danger. It's like abandoning ship at the first sign of choppy waters, only to watch it sail smoothly into the sunset without you. Consider Mark. During a particularly nasty market dip, his portfolio looked like a disaster zone. Overcome by fear, he sold everything. He saved himself from further losses, or so he thought. A few months later, the market recovered, and then some. Mark watched from the sidelines as the very stocks he'd sold for a pittance surged back, leaving him with an empty portfolio and a boatload of regret. He essentially sold his future gains at a discount. This is why emotional decisions are often the most expensive ones in investing. Instead of panicking, remember that market corrections and downturns are a normal, even healthy, part of the investment cycle. They're like the stock market taking a deep breath before climbing higher. If your fundamental research on a company is still sound, and your long-term goals haven't changed, then staying invested, or even buying more during a dip, can be incredibly rewarding. It's about having the conviction to stick to your plan when everyone else is losing their heads. Be the calm in the storm, not another panicked raindrop. Mistake number 6, underdiversification. This is putting all your investment eggs into one precarious basket. We've all heard the adage, but in the thrill of a sure thing, it often gets ignored. Imagine you're betting your entire retirement savings on a single, shiny tech startup. If it soars, you're a genius. If it falters, and many startups do, you're left with, well, a very empty basket. It's an unnecessarily risky gamble, like relying on a single parachute when you have the option of carrying 5. The solution is diversification. It means spreading your investments across different companies, industries, and asset classes, like stocks, bonds, real estate. Think of it like a financial buffet. You wouldn't just eat mashed potatoes, would you? You'd sample a bit of everything to ensure a balanced meal. If one dish turns out to be unexpectedly bland, the others still taste great. This strategy reduces risk because a bad performance in one area is usually offset by better performance elsewhere. It's investing's way of saying, don't put all your hopes on a single winning lottery ticket. For beginners, an easy way to achieve broad diversification is through index funds or ETFs, exchange-traded funds. These are like pre-made investment baskets, holding hundreds or thousands of different stocks. So instead of picking individual winners, you're essentially buying a tiny piece of the entire market. It's like buying a slice of the whole pie, rather than agonizing over which specific berry in the pie will be the sweetest. This way, you participate in the market's overall growth without needing to be a stock-picking wizard. Mistake number 7, ignoring fees and taxes. The silent, stealthy assassins of your investment returns. Just like those annoying hidden fees on your phone bill, investment fees can nibble away at your profits over time, often unnoticed until it's too late. Brokerage fees, expense ratios on funds, trading commissions, they all add up. And then there are taxes, waiting like a hungry dragon to claim a piece of your capital gains. Many beginners focus solely on returns and completely forget about the costs of doing business. A seemingly small 1% annual fee on a mutual fund might not seem like much today. But thanks to the magic, or rather, the tyranny, of compounding, that 1% can devour a significant chunk of your wealth over decades. Consider a $100,000 investment growing at 7% annually. Over 30 years, that 1% fee could cost you tens of thousands of dollars. It's like a tiny leak in a very expensive bathtub. Over time, that drip, drip, drip empties the tub. Always be aware of what you're paying, and seek out low-cost options. On the tax front, understand the difference between tax-advantaged accounts like IRAs or 401(k)s and taxable brokerage accounts. The former offer significant tax benefits that can turbocharge your long-term growth. Investing isn't just about making money, it's about keeping more of it. A dollar saved in fees and taxes is a dollar earned. So, do your research, ask questions, and don't be afraid to haggle for lower costs. Your future self, lounging on that tropical beach you finally afforded, will thank you. Mistake number 8, investing without clear goals. This is like setting off on a road trip without a destination. You might have a full tank of gas and a great playlist, but if you don't know where you're going, you'll just wander aimlessly, burning fuel and getting nowhere fast. Are you saving for retirement? A down payment on a house? Your child's education? Each goal has a different timeline and risk tolerance, dictating how you should invest. Without a target, your investment decisions become haphazard, driven by whims rather than strategy. Let's compare two scenarios. If you're saving for retirement 30 years away, you can afford to take on more risk, aiming for higher growth. Your portfolio might be heavily weighted in stocks. But if you need money for a house down payment in 3 years, a highly volatile stock portfolio is a recipe for disaster. You'd need a much more conservative approach, perhaps bonds or high-yield savings. Your goals are your compass, they guide your investment choices. Without them, you're just sailing randomly, hoping to hit Treasure Island by accident. Before you invest a single dollar, sit down and define your financial goals. Make them smart, specific, measurable, achievable, relevant, and time-bound. I want to be rich isn't a goal. I want to accumulate $1 million for retirement by age 65 is. Once you have clear destinations, you can build a realistic roadmap to get there. It gives purpose to your investments and helps you stay disciplined when the market gets bumpy. Plus, hitting those milestones feels incredibly satisfying. Mistake number 9, using margin or leverage too early, or too much. This is where investing starts to feel like playing with fire, specifically, gasoline-soaked fire. Margin allows you to borrow money from your broker to buy more stocks, essentially amplifying your potential gains. Sounds great, right? Until you realize it also amplifies your potential losses. It's like using a magnifying glass to focus sunlight, beautiful when it warms, devastating when it burns. For beginners, this is a particularly dangerous path. Imagine you invest $10,000, and your broker lends you another $10,000 on margin. You now control $20,000 worth of stock. If that stock goes up 10%, you've made $2,000 on your initial $10,000, a fantastic 20% return. But if the stock drops 10%? You've lost $2,000. Now your $20,000 position is worth $18,000, and your equity is down to $8,000. If your equity falls too far, your broker will issue a margin call, demanding you deposit more cash or they'll sell your investments, often at rock-bottom prices. This scenario is a beginner's worst nightmare. For new investors, the advice is simple: steer clear of margin. It's an advanced tool for experienced traders who fully understand its risks and rewards. Focus on investing with money you actually own, and allow your portfolio to grow organically. There's no shame in starting small and building wealth steadily. Remember the tortoise? He didn't take out a loan to get a head start. He just kept plodding along, patiently, and ultimately, won the race. Don't let the allure of quick gains tempt you into unnecessary financial peril. And finally, mistake number 10, letting your emotions drive your investment decisions. This is perhaps the biggest, most pervasive, and most insidious mistake of all. Human beings are wired for emotions, fear and greed especially. When stocks are soaring, greed tempts us to buy more, often at inflated prices. When they're crashing, fear screams at us to sell everything. It's a classic buy high, sell-low trap, a dance as old as the market itself, and it's a direct path to financial self-sabotage. Your gut feelings are rarely good investment advisors. Picture two little devils on your shoulders, one whispering buy when everything is green, and the other shrieking sell when everything turns red. If you listen to them, you're essentially ensuring you participate in the peak of the bubbles and the bottom of the busts. Investing success often comes from doing the opposite of what your emotions are screaming at you to do. It takes discipline, a clear head, and the ability to ignore the noise. Think of yourself as a stoic lighthouse keeper, guiding your ship through turbulent waters, not panicking with every wave. The antidote to emotional investing is having a well-defined investment plan and sticking to it. Your plan, based on your goals, risk tolerance, and research, acts as your rational guide. It's your personal financial constitution. When emotions surge, refer back to your plan. It prevents impulsive decisions and keeps you focused on the long-term objective. Remember, the stock market rewards patience and discipline, not quick reflexes and anxiety. Your plan is your anchor in the stormy seas of the market. So there you have it, 10 costly stock market basic mistakes everyone makes, laid bare. From ignoring your emergency fund to letting emotions run wild, these pitfalls can severely impact your financial journey. The good news? You now know about them. This isn't just a list of don'ts, it's a blueprint for smarter investing. Think of it as gaining X-ray vision into the financial matrix, allowing you to see through the common traps that ensnare so many aspiring investors. You're no longer the unwitting coffee machine owner, you're the mechanic. The ultimate aha moment in investing isn't finding the next Google or predicting the next crash. It's realizing that consistent, disciplined, and educated investing over the long term is the most reliable path to wealth. It's less about being brilliant and more about being patient, boring, and remarkably consistent. There's no secret sauce, no magic formula, just sound principles applied diligently. It's like tending a garden, consistent care, not frantic digging, yields the best harvest. Investing doesn't have to be a high-stress, high-stakes game. It can be a thoughtful, empowering journey towards financial freedom. Armed with this knowledge, you're better equipped to navigate the market's complexities, avoid those costly blunders, and build a truly resilient portfolio. So, take a deep breath, set those goals, diversify wisely, and remember to check for hidden fees. Your future self, lounging comfortably, will definitely send you a thank you postcard. Probably from that tropical beach, finally afforded. This is just the starting line, of course. The world of investing is vast and fascinating, with endless opportunities to learn and grow. But by avoiding these fundamental missteps, you're already miles ahead of the game. Keep educating yourself, stay curious, and always question the hot tips. We hope this video has not only shed light on common mistakes but also sparked a newfound confidence in your financial journey. Remember, the best investment you can make is an investment in yourself and your knowledge. If you found this video helpful, do us a huge favor, hit that like button, share it with a friend who might be contemplating their first stock purchase, and subscribe for more insights into demystifying personal finance. We love hearing your experiences, so drop a comment below and tell us which mistake you found most surprising, or perhaps, which one you might have accidentally made yourself. No judgment here, just a community learning together. Until next time, happy investing, and may your portfolio be evergreen.